Attend the session today physically, which was expected to. And my other units all have joined from Kalinganagar, from Siliguri to hospitals, and from Ranchi. So my 4 hospital has been joined. So now I hope you can start your presentations.
Yeah, sure. Thank you very much for giving us this opportunity to be of service to you and trying to explain you what financial wellness is. I'm Sharad Avasthi. I'm head of research at Smiths. We are a broking firm with a national footprint, and we are also into wealth management. First of all, I would like to thank you, Medica, and the whole fraternity of nurses and doctors and the whole medical staff who have helped us wade through the disturbing times of COVID. And you people have been instrumental in this impulsive way where we could just move out of it due to your selfless service. So I thank you. I thank all of you for that wonderful service that you have delivered to most of the people across the fraternity. So thank you very much. So financial wellness is something I believe that should be very close to everyone's life, because it brings into life a very striking balance between how you live responsibly and plan wisely for the future of your life, which is also dependent on you and your family and the various members of your family. So everyone, right from your kids' education to how you plan their higher education, to how you plan for the risk or catastrophes that may come or may not come. But it helps you being better prepared than a normal being when catastrophe strikes. So that is the whole objective of financial wellness. In case mostly a catastrophe does not strike, that's even better. So that is why financial wellness is important. And in most places, we see many people don't follow the very simple rules of financial wellness which are to be followed. So hence we have started this exercise across various organizations where we try to train people and make them aware of how financial wellness is important and why it is needed to be followed. Broadly, this is a brief about our company. We are a prominent group, means having a legacy of more than 100 years now, and we have done various kind of businesses across the financial industry space, and we have a lot of experience under our belt over the last 100 years, and one of the very well-known groups across India. And now we are also expanding our reach. We are spread across 11 cities in the country. Our focus is largely the people of our organization, the knowledge they possess, and the innovation that they bring to the table. That is why research is a very important part of the total objective with which we work, whether it's wealth management or direct equity or anything, mutual funds, debt. We plan on these principles only. So the basic principle revolves around people, which could be internal to us, that is the people employed with us, or the clients to whom these people cater or we cater as a group. So that is the most important aspect that we care about. Broadly, financial planning and financial wellness should be integrated, because financial planning will lead to financial wellness. So when we talk about financial wellness, it is a 6-step process as we define it. The first is to establish your goals. So establishing your goals is largely trying to be very clear as to what you want to achieve out of this financial planning exercise. Some people want to do even financial planning for smaller goals, which may be a foreign travel or a yearly travel or a once in a 2-year, 5-year foreign travel where they want an extravagant visit across the globe into some other country and they plan it with their family. Some could plan it for education, some could plan it for retirement. So there are different reasons because of which you prepare different financial plans. And the whole bunch is a total comprehensive financial plan which takes into account most of the things. So the first is to establish your goals. The second is to gather data. Now data gathering is what? Data gathering is understanding what you need and how viably you can achieve what you need. So there are people who would come and say that I want to deposit 1,000 rupees a month, but I want a corpus of 1 crore in 3 years. Now that's irrational exuberance. Usually does not happen unless and until you get very lucky somewhere. So gathering data as to what you need and what kind of investment instruments would suit you and what are your goals, how to establish your goals. So you need a lot of data gathering to be done. Third process is evaluating your current position. So what is your current position? If say I am at the age of 50 and I want to generate a corpus out of my next 15 years, which is much higher than my ability to earn or save, then it does not make sense. I will not be able to do. But someone at the age of 20, 25, just starting a career we can have a different plan. We will talk about it in detail, that what is the importance of starting early, how starting early or starting later impacts our ability to save what amount of purpose. Okay. And then there is develop a plan. Now, once we have evaluated our current position, established our goals, gathered the data, then we develop a plan as to where do we put. Now, the plan would largely revolve around your investment allocation, what amount of money we are going to put into what asset, what is going to be the broader plan, what time frame, what frequency. Now, these things start coming into place. And then is the implementation of the plan. Once we have decided on the plan that these are the investment avenues, I want to put so much of a systematic investment plan, that is a monthly deposit into a mutual fund or any other kind of instrument, which is very similar to a recurring deposit, which most of you would be aware. So then that plan is implemented, that whatever we have thought of in terms of goals, systems, what we need to put, and then we decide that this is the money we want to put into this asset class and this is how we want to place it. And the sixth part is monitoring it regularly and reviewing it. That's a very important part, because goals can change over a period of time. Suppose you set a goal for some kind of corpus accumulation over a period of time, but you fail to do it over a period of time, then obviously some recalibration or some readjustment needs to be done to that goal. So that monitoring with a regularity and then reviewing it as to if any course correction or course change is needed, that is something we do. So this is broadly the 6-step process, which is establishing the goals, gathering data, evaluating your current position as to where you stand with respect to what you achieve. This is a very important aspect. And then develop a plan, implement the plan, and monitor and review the plan. This is where your wealth manager and everyone would come in and handhold you through this 5-6-step process. And they can properly guide you as to what is a sensible plan to follow and execute, and what your expectations should be from that plan. Like, there are some misconceptions that financial planning to only bodo lokra korbe. We hardly earn anything, तो अभी financial planning को रेकी करबो. What will I do with financial planning? मेरे को financial planning नहीं चाहिए, ये तो पैसे वाले लोग का काम है, हम क्या financial plan करेंगे? नहीं, financial planning हर किसी को चाहिए. आपको अपने resources के अंदर जिसकी जैसी whatever is your propensity to earn, you adjust your propensity to consume according to that range, and you also adjust your propensity to save according to your earning potential. So that is how we set the whole thing going, right? So everyone needs that, and insurance planning is not financial planning. Aapne insurance le liya, that is not financial planning. Insurance planning is contingency planning. Suppose something goes wrong in my family with one of my members or with me, then there is an insurance plan to take care of their requirements past my problem, or any kind of, if I have a medical insurance, that is a contingency plan. That suppose I have a hospitalization plan or a hospitalization problem, then I can address that. But it does not account to financial planning. Financial planning is planning the whole gamut of things, whereby we reduce the risk from unforeseen events, while at the same time we save for the events that can be foreseen over a period of future period of time. Tax planning is financial planning. Again, tax planning is part of financial planning. Tax planning itself is not financial planning. Because tax planning is also important, because if you can efficiently plan your financials to reduce your tax liability as far as possible, staying within the legitimate rules, that's a very good thing to do. But that in itself is not financial planning. Then some people say, I'm too young now to start thinking about financial planning. Financial planning is something, the earlier you start, the better it is. Because the more you age, your responsibilities will go up, the number of people dependent on you will go up, your expenditures will go up. It is not going to come down as you age. So the earlier you start, the better it is. And just investing is not financial planning. When you invest according to a plan, it is financial planning. Investing is part of financial planning when you follow a plan. But just because you are investing somewhere, it does not mean that you have planned your finances. or you have adhered to some financial planning. So you have to invest according to the plan. That is financial planning, right? Now look at this example below. One, which is A, starts contributing 10,000 for the first 5 years, her monthly contribution. Then her monthly contribution for the next 33 years is just 5,000, right here. So for the first 5 years, she has contributed 10,000. For the next 33 years, she has contributed 5,000. And considering with a marginal yield of 9.5%, her total investment will be 24.8 lakh and her final corpus will be 2.51 crores, right? But look at the other person, that is Lady B. Now, what she has done is she has not invested in the first 5 years, but in the rest of the 33 years, where this person is investing 5,000, this person has invested 10,000 per month and invested an amount which is roughly 50% higher than the first person, right? But still the corpus is lower than the first person. So this is the importance of starting early, being regular, and building a corpus, because compounding, as we all know, is the third wonder of the world. And these are based on expectations that you only make 9.5 to 10% kind of returns, not some exorbitant 15, 20, 30% kind of returns. So even a simple method, starting early, helps you to overcome a lot of the uncertainties in future. And it is a very sensible way to start as early as possible, right? This is broadly more in context of your mutual fund investment, which goes into any kind of asset which sees some volatility. So what happens is mostly it is relevant for equities, but considering how we are maturing on the debt side of the market, gradually debt side also experiences such volatility at points of time. And usually what happens, we go to people and we see that the markets are going up. From the first stage, if you look at this is wow, I am smart. That's the guy who makes the maximum mistakes. And we start saying that, yeah, we are very optimistic, then excitement, then thrill. But the problem comes that most investments come in when euphoria is here. Like recently, if you see, when Bitcoin prices started going up, no one spoke about them, no one was interested in them. But once they reached their peak levels, everyone was interested in buying a Bitcoin. So that's how the behavior changes over a period of time. So that is something we need to understand, that euphoria will be highest when valuations are abnormal. This is relevant for all investment asset classes. So if you can, what you do is with your regular investment through this period, you achieve the objective of a mean, because everything will go up and go down and fall back to a mean reversal. So when you keep buying regularly through the ups and downs of a cycle, you average out your costs and thereby you do not enter. So do not listen to people when they come, when you have adopted a financial plan and you are sitting on it for a plan of say 8, 9, 10 years. Do not switch your plan very occasionally. Captains are very reason to do. Most probably be buying and you'll be exiting at the lower end and you'll be buying at the highest time. The sentiments are in both sessions. So you have to be regular and consistent with your approach and regularly allocate some money to these investments at regular intervals rather than respond to fear, despondency, or euphoria. This is a small snapshot of how investor behavior is reflected. Like, look at this. This is behavior of an investor, and this is the behavior of your speculator. So, when as an investor, you should be focusing on long term, more than 5 years. Do not get attracted to low short term benefits. That does not make sense. Have immense patience. You have an investment philosophy in place. You are a value player. But these are more for direct equities. Would not make sense. Now, look at this thing that we were talking about. What sentiment does to you. Now, Sensex valuation were 2001, and after that 2 years 20%, next 3 years is again 20%, 5 years is again 35%. So as you see, as the time horizon is going up, your revenue earning potential is also going up. Like 2 to 3 years, when there is a smaller time difference, 2 years, 3 years, it's just one additional year, your CAGR returns don't really vary so much. But as soon as you give it more time, your equity investments are starting to give you very fantastic returns. Similarly, in October 2008, when markets corrected, see after that what happened again, next 2 years, it goes up, 3 years, it does not go up, which largely signals that the third year you had a bit of correction. 5 years, the CAGR is again 13 14% only. Nothing compared to the first cycle where we were making 35%. So this is what we need to understand, that when you are investing into equities directly or indirectly, it is a volatile asset class in the shorter term, but in the longer term, most of it balances it out. So as soon as you see that 2008, even then it is not very rosy, even then you have a 13-14% kind of CAGR. Similarly, I will show you what pessimism done when the index was at a high PE multiple. Look at Feb 2000. Feb 2000, everyone was very optimistic. This was prior to the IT crash. Everyone was very optimistic. The world was very optimistic. All IT stocks were rolling at abnormal valuations. And look at the returns from indices over the next 2 years. But what happens is very interesting, that even when you bought at high valuations, as soon as you give it more time, your returns have improved and you are sitting on positive return over a 5 year period. Though it is meager and illogical, it is not very material, 2% return compared to 8 to 10% returns that are available there. So that's a challenge. But most of the times you will see that as more time is passing on, your returns are comparatively much better. But when you are buying at a higher level, the probability of you is lower. This you overcome by work to an SIP or something. You gradually invest. So averaging concept. Suppose you buy something at 100 rupees today, the same thing you buy at 50 rupees, say 2 years later when it comes down, so you end up buying more. So your average cost averaging concept also plays. So your average cost comes down, thereby your returns are and lump sum. As we understand, is broadly the securities market and the money market. Money market is largely the debt side of it, and the securities market is largely the equity side of it. Primary and secondary market, IPO market, listed stocks, unorganized and organized money market, short-term borrowing, money lenders, indigenous bankers. Now there are many instruments further beyond it. And then within mutual funds, which is the most preferred investment for retail or smaller individual investors who don't have the time to delve into direct equity, that's a very important aspect. Mostly we would be focusing on the open-ended type of it, because close-ended are very rare and seem to be found now. Mostly they are open-ended, and they can be broadly divided into equity, debt, money market, gold. Gold is largely treated as an alternate asset class where we invest when we have some risk aberration, that suppose we expect that the Ukraine-Russia war fallout can be very high, then we invest through ETFs in gold to protect the downside, not for appreciation. In case some appreciation comes, that's a bonus. Money market are ultra short, liquid, very short-term parking funds. Say, so you have some surplus funds for a period of 1 month, 15 days, you can even park it there, expect returns of 3 to 4%. Debt, we have different guild is basically government securities. These are totally secured, sovereign, sovereign guarantee. Then we have long-term bonds, short-term bonds, medium-term bonds, which we can invest into various cycles. For equity, it is largely diversified into large cap, mid and small cap, multi-cap, sectoral or thematic. Add to that balance advantage funds where they do a lot of asset allocation within the fund, so we can also work on those lines. Now, while small investment is important, now look at this. Even a small investment of 1,000 per month can become 29.4 lakh over 30 years, assuming a 9% return. Now, 1,000 per month, we ought to believe that it's a very small amount and nothing material can be achieved. But I believe if you end up saving 35 lakh rupees over a period of 30 years, that is a substantial saving for someone who's saving 1,000 per month. And this is assuming just 9% returns, right? Most equity investments over the long term have yielded around 15 to 16% CAGR in the past. And once you apply that, this number can be substantially higher. I believe 30 lakhs would be somewhere around 45 to 60 lakhs if we are talking about a 15% CAGR. So never ignore the fact that a small amount of investment consistently done over a longer period of time can lead substantial benefits to you and improve your savings by a huge amount. This is brief according to the various investments. That on this side we have the risk profile, which largely tells you what is the kind of risk a particular asset carries, and this is the time horizon at the top, which tells that what is the tenure of the investment. So when you are equity investor, you should be looking at this kind of return 10 to 12%, and your horizon should be 7 years or above. And for sector funds, 4 to 7 years is an ideal horizon. For medium term liquid and medium term debt funds, it is 1 to 3 years, and the risks are very medium in nature. So, the lesser the equity or the more aggressive or volatile asset class, at the same time, the asset class that can create an alpha or higher return for your portfolio, and the better it is, the higher the risk and then higher the tenure. And now these are some myths. An SIP, we believe most people think that once they commit and go to an SIP, say I commit to an SIP of 10,000, I cannot reduce it. At any point of time, you can reduce it depending on your financial viability. Suppose there are some challenges and you want to halve the amount or make it 5,000 per month, then you can easily do it. That's not a challenge. SIPs guarantee positive returns. No, they do not guarantee positive returns if you are doing it into any kind of asset class, because generally what is understood as the law of cost averaging, and as you go long term, it substantially saves money for you and you do not incur long term very large or incremental losses. Generally, you only make money, but it is not a guarantee that there is any positive return like a bank FD that will give you 5-6% per annum or something like that. So, and penalty if you stop an SIP. Anytime you can stop an SIP, you may go for a perpetual SIP forever, but you can stop it anytime at the notice of a day or two. If you just tell your broker or your banker or the mutual fund that you are working with that I want to stop the SIP, you can stop it. You can restart it at any point you want. Many people believe that SIPs are only to be done into equity mutual fund. Not necessarily. If I have the savings and I think that I do not want to take the headache of equity investing or the volatility or the risk associated with it, and I'm happy with a 5-6% kind of return, then obviously even debt mutual funds you can do and stay put into them. There is a lot of option available. Fixed maturity plans are available. You can also plan on those. Though SIPs will not be able to do into FMPs, but the one-time lump sum can be done. Normal debt funds, you can do that. SIP must be initiated when market is bullish. I think that is the biggest problem. What we advise is you largely do the asset allocation of the corpus that you have built up over, say, 3 to 5 years in an equity SIP or any kind of SIP, and work on the asset allocation of that. We will discuss that at length and later. But you should not be timing your SIP. Your SIP should continue because it is based on the cost of averaging, right? So, on the logic of averaging, so cost averaging will only happen when you continuously put money irrespective of market levels. Now, coming back to the point what I was telling. So, what is interesting in the lower chart, right? These are the cycle returns. So, we try to understand that in 2000, the markets were at a high, IT boom and everything happened, and then they crashed after IT, and then again around 2008, we were again at all-time highs. So, look at it. The first is if you buy at the highest point of the previous cycle and sell at the highest point of the next cycle, then these are the kind of returns you make. You make 17.27% in 2000 to 2008, and 2008 to 2018 you would have made 5.8%. But the most important part is this one, that you bought at a high and sold at a low. So suppose when 2000 happened, at the peak of the IT boom, I bought into, say, the index, right? And then I sold at the lowest point after the 2008 crash, right? So even then, I made a 4.93% return. So the biggest risk that people have, or the perceived risk that people have, is that equity investment comes with a lot of risk, and I could lose a lot of money. You could lose a lot of money when you try to time it and try to oversmart it, because every one of you would be working full time into something or the other. So for you to go out and time the market and trade the market is not a sensible approach to do. If you have that capability, if you have that knack, if you have a very good advisor, it makes sense. But you need to understand that you will need a very strong advisor, trusted advisor, very good advisor. So someone from Smiths can help you with that. Then it makes sense. But if you cannot devote that kind of time and energy, and if you do not have a very reliable advisor, even buying and staying at the highest point and exiting at the lowest point of the cycle, which would be the most means you made the wrong decision at both times. You entered at the wrong time, you exited at the wrong time. But in spite of that, in both the cycles, you ended up making 3 to 5% returns. You did not have capital erosion. So that is how important it is. Now look at this above. Now most people would recommend for the senior guys or for someone who's nearer to retirement, they would be largely putting their funds into large cap Nifty 50 kind of. So these are SIPs. So SIPs have yielded these kind of return over a 2 cycle period. So 2000 to 2019 covers two full illustrious market cycles where market peaked and bottomed out. So if you had a mid cap fund SIP or a large cap fund SIP, you would be making 20, 19 to 20%, right? But similarly, some mid caps or even the Nifty 50 SIP would have, which is the frontline three best of companies, you would have made somewhere around 15% return. While an index lump sum, which is a buy and hold, suppose you put in all your money at the start of 2000 and you exited at the highs of 2018-19, then you would have made a return of 10% only. So even the worst category, which is this Nifty 50, 100, Nifty mid cap 150, which saw the maximum erosion or the lowest possible returns, even there you made more money than doing a lump sum investment at the start of 2000. So this is the importance of cost averaging. If you look at the difference in return, so a 2.5% return differential or a 5% return differential or a 10% return differential over a 20-year return, even if you simply understand it, this is without compounding, your returns are much higher actually because you are roughly doubling your returns. So that is the importance. So if you are into early ages, most of your investment should be into mid-cap, large-cap funds where you invest for the long term and generate the maximum alpha for you. Now, there is a low to high situation, which is for someone who's extraordinary, bought at the lows and sold at the highs. You can see the returns. But generally, it's a very rare case that happens to anyone. The second aspect that we need to understand is about insurance. So I think before insurance, should we break and have a brief Q&A regarding this? Because we have already run 30 minutes into the presentation. So shall we have a brief Q&A? If someone has some questions regarding equity, mutual fund or planning, then we can address that. And then later we can go back to restart insurance.
Hello?
Yeah.
Yeah.
So I think we have run 30 minutes into the presentation, ma'am. So we can do a small Q&A on the part that we have completed till now. If someone has some questions, and then we can move to the second round, which would largely cover insurance, the needs of it. Or do you suggest we run through the whole presentations and then do the Q&A?
We can all, go through the all your presentation, and after that Q&A, we can go ahead like this.
Okay, fine. Then let me restart with insurance.
Meanwhile, if any participants is having any query, you can chat here. The chat box is open for you. So you can chat Mr. Sharad. He is there to answer your questions and all. So you can, as we are in a webinar, so I hope everybody is not audible. You can chat, mention your question in the chat box.
Yeah, okay, that can be done as well. Fine. Okay. So the next important part in financial wellness, as we spoke about earlier, we have spoken about investments. The second part covers the risk part of it. So all of us have very closely seen what risk can do to our lives and how changes can happen suddenly and without any prior intimation. So what kind of insurance do we do? So there is protection and coverage insurance, and the need at every stage of life is very different. There is medical insurance. Some people do like David Beckham legs and many other some body part insurance, which is part of real business. You could do have a new job. You got a new job. You have rented an apartment or house. You have bought a car. So now car insurance and everything everyone does. With respect to kids, we do a lot of insurance regarding their higher education or regarding some future plan, retirement planning through pension plans. Buying a house, if you go today to buy a house with a home loan or something, the bank does an insurance for you to cover for the risk they have. Similarly, we can have a lot of fire, burglary insurance, and other risks, other insurances that can have. But generally, the most important part that we think is largely life and term insurance and car insurance and house insurance. These are the most important. Medical insurance, because these are the emergencies that we face regularly. So that is why insurance becomes very important, because it takes care of the sudden possible outflow that can happen to any of us, which substantially damages particularly the middle class or the vulnerable class. We have more damage coming out of it, of sudden expenses, because today hospitalization in very good hospital, once you are hospitalized, you can expect a bill of 5 to 6 lakhs, which substantially sets you back if you are a middle class family. So that becomes very important. Fire insurance, burglary insurance, car insurance, we all know, bike insurance, these things we cater to. So insurance in every term is very important. Now most people, what they do is we confuse insurance with savings. Still it is being sold as a saving instrument. But you should only consider insurance as a coverage instrument, whereby you cover the risks associated to your life and the people who are dependent on you, how they will cater to life if something happens to you, or there is a medical emergency or something like that. The types of insurance are general insurance, life insurance. So general is basically spread across health, motor, travel, home, fire. Term would be term. Life would be basically spread across term, whole life insurance, endowment policies, ULIPs, child plans, pension plans, money back policies. All this we can do regularly with various instruments. And so insurance is of relevance when you try to cover the risks associated with your life. So if you can properly invest into proper instruments and plan your finances for the future, that takes care of one part. For the emergency and contingency part, insurance takes care of the second part. Uh, then there could be some PMS products like at Space. We have these PMSs which you can opt for. Uh, then these are basically 10 rules, 10 thumb rules of financial planning and wealth. So you should always save 30% of your take home pay. So generally that's a problem, that we tend to spend too much. So as Warren Buffett has rightly said, that most of us should spend after saving and not the other way around. But I believe most of us spend and save what is left after spending. So we need to change that, and at least as a rule of thumb, you should be saving 30% of your take home pay. So if you are say earning around 50,000 or 1 lakh rupees, so out of 1 lakh, at least 30,000 should be your saving per month that you should be setting aside and investing. And based on that, we will prepare a financial plan. Keeping 3 months of monthly expenses in an emergency fund. So everyone should have around 3 months of their monthly expenses in an emergency fund, in case anything strikes, whether it's family emergency or anything. So everyone should have around 3 months of emergency plan. Life insurance. Now, the major question that comes to everyone's mind is that if I'm taking a life insurance, what is the ideal cover that I take? We look at many people who have a lot of earning potential, but their insurance coverage is very small compared to what they are. So, ideally, it should be 10 to 15 times of your annual income. The logic being that when the money comes to you, your family, even after you, does not have to curtail their lifestyle. Because if they get 10, if they are ideally yielding around say 8 to 10%, then what will happen when you have, suppose you have a salary of around 12 lakh rupees, and you have a insurance cover of 10 times, which should be around 1 crore 20 lakh rupees. Then on that they could easily yield interest income into safe assets, also would yield them around the amount of money that you were earning, so their lifestyle does not get curtailed even in your absence. So that is the logic why it is 10 to 15 times. The value of house should not exceed 2 to 3 times of your family income. So it is also dependent on the fact that if you put too much money into a house, you will not have liquid savings, and you will be pushing too much money into a house which is not your liquid asset, which is the house you are living into. So ideally, you should not have a house which is more than 2 to 3 times of your family income. Ideally, though it is very difficult to find nowadays. On-road price of the car or the vehicle that you buy should not exceed 50% of your annual income. So that is one thumb rule that can be followed, so that your EMIs and outgoes, because any kind of transport that you take is a depreciating asset. So we need to understand that depreciating asset. Many freshers usually end up taking huge education loans. So you should plan education loan very sensibly, and it should not exceed expected first year salary. That is one way of being financially savvy. Total EMI should not exceed 40% of your take home pay. So if you are paying more, if your EMIs exceed 40% of your take home pay, you are doing something exceptionally wrong, and it will put unnecessary pressure on you. So you should not have more than 40% of your take home pay in EMIs. Equity allocation, what should be the equity allocation? Many people ask this that according to my age, what should be. So unless and until you are talking to a financial advisor who's actually guiding you through the whole process, your ideal approach should be that you decide that suppose I am at the age of 45, so my equity allocation should be around 55. So similarly, if you are 25, your equity allocation should be 75. The logic is that gradually you can you have more time on your side, so you can take more risk because equity is considered as a risky asset. So the higher your age, the lower is the risk recommended. Then there is the rule of 72. The rule of 72 is basically that any number divided by 72 by the annual rate of return on investment to determine the time it will take to double the money. So if you want to calculate that in how much time an investment will double, you can use this rule. Aim for 20 times of your gross income as a retirement purpose, generate 80% of income from savings. So your ideal target, if you are planning a retirement purpose, so how do you decide what your retirement purpose should be? So your retirement purpose should be 20 times your gross income. And you will be generating 80% of your income from savings. So that's how it is planned. Uh, at Smiths, what we do is mutual fund, insurance. Mutual funds we have spoken about in brief. Insurance also we have briefed you about. Portfolio management and advisory is also there for the affluent category because the minimum amount there on portfolio management is somewhere around 50 lakhs. For equity, commodity, currency broking, we could help you. Beyond this, also, if you look at the various offers that we have, like we give this optimizer PCG newsletter to our retail and HNI people. So in this, what we try to achieve is we try to give you a brief regarding what are the investments that we make, what is happening in the financial investment market, whether it's debt, equity, and what has happened and what is expected to transpire. So you will get a brief overview. And similarly, based on your profile, whether you consider yourself conservative, moderate, or aggressive as an investor, we also give you an ideal block of mutual funds and the asset allocation percentage as to which fund you should put how much money into. We also plan to put in some handmade or custom-made portfolios, direct equity portfolios for you in the future. So this is something we will be giving to you. And the asset allocation, you can also visit the website to get a brief. If you fill up a brief query on our website, based on your various tools, you would be allocated a tag whether you are conservative, moderate, aggressive, and then by clicking here, you can get a model portfolio. Putting in these details, you can get a model portfolio as to what allocation you should do into which fund and how. Right. We also send out monthly recommendations to you every month. So these are basically hand-picked funds based on our proprietary research across various asset categories. So if you look at this, we give you these hand-picked funds which are based on our proprietary research. So every month you will receive the list of these funds across various categories: equity, debt, hybrid, every asset, every class basically, even alternate asset funds, gold, etc. That which are the best funds you should be putting your money into, and you can decide your allocation out of this as well. So this is how Smiths can help you. We have more than 40 years of experience. We are servicing around 11 cities. Strong PMS and advisory. The institutional team is very strong. We have around 12 to 13 analysts right now. Research again is a focus that we have. We are largely focused on paperless account opening. One-stop financial solution. I believe anything under the sun which is related to finance or investment, you can most probably be serviced by Smiths. We have our apps, whether through mobile or desktop or EXEs, and this is basically hassle-free. Even our Telegram channels are there. You can subscribe to them and get recommendations on research. There are no account opening charges, competitive brokerage, mobile and internet-based equity trading. So it's a DIY mode where you can go and do it yourself. Mutual funds also you can do through the app or on the EXE. There's a call and trade facility. Basically, SMS and email alerts. Real-time back office is also available. These are the apps that we have largely, which is the mutual fund app, the stock broking app, and the back office app where you can at once access everything, whatever you want to see regarding your investment. We have around 57,000 clients spread across the country. And these are our channels, Smiths Limited and Smiths Research. So Smiths Research, Smiths Limited, you will get most of the updates regarding whatever is happening in the markets. And Smiths Research is basically covering everything across equities, mutual funds, equity recommendation, commodities, whatever under the sun, so you can have a brief look at it and understand. Mr. Suman, you would like to say something in addition? I believe I have completed my presentation. We can begin the Q&A.
Sharji, we can start with the question and session.
Yeah, please. So I have no questions on the chat box. Yeah, we can begin with the Q&A.
Yeah.
It's something, yeah.
Madam, if you can address the audience once, if any question answers.
Any question from the participants from Medica Ranchi, Medica Siliguri, Medica Kalinganagar? I would like to request Ms. Mansi, Ms. Sunanda, and Ms. Manisha, if your participants is having any question, they can write in the chat box.
Ma'am, you can enable audio for everyone, also enable the videos from everyone if possible. That's not a big deal, I believe.
Sorry, sir?
We can enable the audio or video for most people, so they would be comfortable. We can.
Like an open session.
Yeah, it's more interactive basically.
Just let me check all this.
Yeah, if it's not possible, we can put it here on this.
I think you can unmute everyone.
Yeah, you can unmute.
Yeah, it's all are unmuted. I haven't not.
No, you can see all are muted, ma'am.
Let me check one sec, please.
Yeah, that's good.
अरे सबको ही अंग्रेजी के डर से तो सवाल नहीं पूछ रहा, ऐसा तो नहीं है. हिंदी में भी पूछ सकते हैं, बंगाली में भी पूछ सकते हैं भाई.
I can understand a little bit of Oriya also. TK.
तो उड़िया you will have to handle. I cannot.
Yeah.
Bengali, Hindi, I'll be able to handle. Okay, kindly explain thumb rule number 8. 1 second. So, yeah, Dipankar Ghosh has asked that kindly explain thumb rule number 8. So, thumb rule number 8 basically says that your equity allocation should be 100 minus your age. So, suppose you are 25 years right now, I'm assuming. If I'm assuming you are younger, you should be happy. If I'm assuming that you are 25 years right now, so out of say you have 100 rupees, we plan that we invest 100 rupees per month, right? So out of that 75 rupees per month, you would be putting into equities and 25 into debt or other asset classes. Am I clear?
Ranjit, there is one more query in this chat box from Nupur Mustafi.
Nupur Mustafi, right. Hello sir, if I require some finances for a short-term goal, small cap MFD advisable. Short-term goal will invest in small MF. No. Short-term goal, it depends. Like as we explained in the slide, that unless you have a longer-term horizon, since we are not doing trading or we are not trying to time the market, you should not be planning your short-term goals based on equity markets. There is a lot of uncertainty. And based on that, what can happen is, suppose I put my money into equity markets, assuming that the returns would be around 10% or 15%, and suddenly a catastrophe strikes, which could be global in nature, nothing to do with the local markets or something, but the markets can correct. And they may not recover, say, for the next 6 months, 8 months. So, unless and until you are a long term investor, your short term finances should not be planned out of equity mutual funds. When you talk of small cap mutual fund, it is an equity mutual fund. Since it is small cap, it is the most volatile asset class. So you should not be putting money into it for your short term financial planning. Thank you. Anyone else? How many people are there? I can see 59, 60 people. Yeah. Hemant Kumar Barik, 6 to 7 lakhs. What should be the amount he should invest in mutual fund? See, if you are planning, Hemant, thank you for the question. If you are planning to do all your savings through mutual fund, then out of 6 to 7 lakhs, as we said there, 30% of your money has to be saved, right? I am assuming this is without tax, and 6 to 7 lakhs, ideally you should not end up paying much tax given the current taxation structure. So 6 to 7 lakhs, at least 30% you should be saving. So I'm expecting that you are doing your ATC savings, which is around 1,20,000, 1,50,000. So 1,80,000. So additional 30,000 you have surplus. If you are not doing anything under ATC, then you have a probability of investing 1,80,000 into various mutual funds and various schemes based on your risk appetite. I see you are a young guy. It would be 100% equity basically. Was that clear, Hemant? Okay, great. Someone else? 60 people are there. We should get at least 120 questions.
All of you can verbally ask also. I have given you the rights to speak.
There are two questions. Mr. Dipankar Goel, what type of mutual funds we need to take for a short-term goal? For a short-term goal, you should be doing it ideally through debt mutual funds, money market funds, liquid funds. They are good for planning your short-term goals, basically. And short-term is actually, we are talking of less than 1 year or a very shorter time frame. And Mr. Suhail Kasir, right? What is a Sharia MF? So Sharia MF is a mutual fund which follows the Sharia laws of investing. So as we all understand that there are different laws for Sharia investing, they follow a very different law or set of laws whereby they do not invest into certain investments. जैसे ब्याज खाना हराम है, so they would not put money into the BFSI space largely because they earn interest on it because they don't consider it as legit under their religious beliefs. तो शरिया में वो ब्याज वाले इंस्ट्रूमेंट्स में पैसा नहीं लगाते, बैंकिंग स्टॉक्स में पैसा नहीं लगाएंगे, वैसे ही और भी डिटेल्स होते हैं. तो जो शरिया के जो रूल्स हैं जो उनको फॉलो करते हैं, there we say that we follow the Sharia, that is a Sharia MF, right? Hemant has again come over. In the current scenario, how much is it advisable to invest in share trading? See, it largely depends on your investment appetite. What you should be committing to share trading. And when you say trading, understand that trading and investment are different things. Investment is generally done for a longer time horizon, and since you are trading, you're talking about trading, it is largely direct trading, direct equity trading. You will be buying listed shares on and off the exchanges. So what you need to do is that you need to have a very good understanding of how trading is done, and you need to define your risk, you need to define your discipline, that on what basis you want to enter into a stock. You need to decide your asset allocation, the number of trades you will take, how you will exit the trade. It is a wise thing to do, but you have to understand that it is a full-time job. So along with your work, whether you will be able to do trading or whether you have a very reliable financial advisor in place who can help you with trading, then it's a very different ballgame where they can take care of your problems. But otherwise, it's a cumbersome process. So it would only be sensible for you to do trading if you can take care of that part. Do a bit of learning about trading, how trading is done, how the discipline is set, how the size of your trade is set, and always commit a very legitimate or small amount into trading, so that the risk is very high there basically. So even if you end up losing a lot of your all the money or a major part of your money, it does not create an imbalance into your financial positioning as a trader. I believe someone just raised a hand. Can you just ask the question, please? Yeah, Mr. Dipankar Ghosh, I believe you want to understand are the returns on mutual funds better than FD or RD? See, as we spoke during the presentation, the tax planning is also a very essential part of it. Right now, your FDs yield you around 5 to 6%, right? And you do not have any tax advantages. What happens with mutual funds is that you can take an indexation benefit on them, and the LTCG and STCG rules apply. For FDs, you don't have any LTCG, STCG rule. So that's the difference. If you look at the post-tax returns, you substantially benefit out of a mutual fund, because if you adjust the 5 to 6% return that you make on a mutual fund and adjust the base price of that bond if you hold it for a long term with indexation, your effective tax rate is literally zero. So that's an added advantage if you're holding on to a debt-oriented mutual fund. In the long term, for equity-oriented mutual fund, it's even more. But obviously, an FD cannot be compared to an equity-oriented mutual fund. An FD has to be compared to a debt-oriented mutual fund. So there, obviously, your returns, post-tax returns, are very much better than a fixed deposit. you. Mr. Kasser, I don't have a return handy because that's not a very active class, the Sharia mutual fund that's specific to you. So I'll tell someone from my team to get in touch with you, and I'll tell someone from the mutual fund research team also to gather the data and give you some Sharia mutual funds. Is that fine? Sumanda, you can kindly take the number of Mr. Suhail Kasser, and we will just inform him about the Sharia mutual funds that are available in the market.
Yeah, we will. It's noted. So, it's noted.
Okay, thank you.
Shwelji will get back to you shortly.
I don't think there are any more questions. So, you conclude, please.
Any more questions from the participants, please? No, ma'am.
And even for the senior levels, those who are at the verge of retirement or maybe, see, no time is bad for starting a fresh planning, right, Shraddji?
Exactly. No time is bad. It's better late than never.
Yeah, always. Jyoti Babu became CM at the age of 62.
Politics is a different ballgame. Everything starts late.
You talk about Satyajit Ray, he directed 6 films after 60. I will say it's film. Now I can say Dr. Narayan Murthy, 67, he came back to take the challenge of Infosys. So all the seniors, please, if you have questions, any queries, we are there always to,
Yeah, you can also share your numbers with them in case they have some specific queries which you want to address offline. That can also be done.
Yes, sure.
So we'll wait for a minute or two, and if there are no queries, then I believe Mr. Suman will make the concluding remarks and we'll call this a day.
Any more questions from Medica Ranchi or Siliguri or Kalinganagar?
No more questions from our side, ma'am.
Medica Kalinganagar, Mansi.
This Jaita Roy, PPF or FD, which one is a better choice? Okay. See, ma'am, PPF has a lock-in in place, whereby you cannot withdraw some part of the fund. If you consider tax-wise, obviously, PPF is a very good option because if you are in the higher tax bracket, it makes very much sense because the returns are largely tax-free in nature. FD is taxable, so that is a different. But depending on the group of taxable bracket, basically, which you belong to, that decides how good or bad or an investment instrument is for you. So if you am assuming that you are not in the highest tax bracket, if you are in the highest tax bracket, then a PPF makes sense. But as you all know, that you cannot invest more than 1.5 lakhs, I believe, into a PPF. So there it does not leave much scope if you are planning for a larger purpose build up there, though you can do it annually. FDs are a very simple, plain vanilla thing. They are probably the best thing that you can do because the liquidity is at hand. There is no lock-in. So if you are looking at liquidity, maybe FD is better. But if you are not looking at liquidity, you are comfortable with locking your funds for the 12-15 year kind of horizon and going through the pain of taking a loan or something in case you want to withdraw earlier than that, then even a PPF is a much better option.
For the Kalinganagar team, I do visit Orissa, Bhubaneswar specifically, at least once in a quarter. So if you need any one-to-one discussion kind of thing, you can always, be in touch. I have shared my number with you. So once I'm there, if you need, you can sit and then we can have a discussion and the rest of the planning.
Okay. Definitely. We'll be in touch with you.
Oh, thank you, Energy. So, ma'am, I think it is now. No questions are coming.
Yeah, I think there are no more questions from the participants end.
I hope everyone has enjoyed and.
Yeah. We have enjoyed. We have learned a lot of things. Thank you, Ranita, for a wonderful session. So hope this type of session should be continued henceforth, so that we'll be educated on that.
Yes, was there, and thank you everyone for the participation. And we would like definitely to do it in much more bigger way and in a very shorter span.